Good morning, everybody. In our earlier lecture on marginal costing, we discussed what is marginal cost, what is marginal costing. We also discussed its limitations, advantages, and important terms. We also discussed marginal cost equation, which is very important to calculate practical questions. Now we will start again and cover the practical aspect of this chapter in our current lecture. Now we will start with marginal cost equation. It has already been discussed. Marginal cost equation is equal to S minus V is equal to C is equal to F plus P. There are two sides of the marginal cost equation, left hand side and right hand side. Now the important terms which were earlier discussed, the first important term was contribution. Contribution is a difference between sales and variable cost. Difference between sales and variable cost. It is denoted by C and is equal to sales minus variable cost. S here means sales, V mean variable cost. Example of contribution: suppose selling price is rupees 200 per unit, variable cost is rupees 110 per unit, then contribution will be S minus V. S here is 200 rupees minus variable cost 110, then contribution per unit will be 90 rupees. Why we should calculate contribution? It has certain advantages. The first advantage of contribution, it provide help in setting fixation of selling prices. Contribution provide us help how we should fix selling price. Next, it help us in the selection of suitable product mix. Third and most important advantage of contribution, it help us in determination of break-even point. Break-even point here means the point at which there is no loss, no profit. It is a point at which total cost is equal to total sales revenue. Next advantage, when we are to add new product or drop old product, then contribution provide us necessary help. Second important term which we discussed, which we are to discuss today, is profit volume ratio. Other name of profit volume ratio is contribution or marginal ratio. Profit volume ratio is denoted by P upon V ratio is equal to C upon S. C here mean contribution, S here mean sales. If we are to calculate in percentage, then C upon S multiply by 100. If we write down marginal cost equation, we will come to know S minus V is equal to C is equal to F plus P. C is equal to F plus P. By putting the value of C is equal to F plus P over here, marginal cost, then PV ratio will be F plus P upon S multiplied by 100. By putting the value of C is equal to S minus V, then PV ratio will be S minus V upon S multiplied by 100. Then important aspect of PV ratio, when we are given the data of 2 year in question, then the PV ratio will be calculated as change in profit. If profit is given, change in profit, or contribution. If in question contribution is given, then we are to calculate change in contribution, as the case may be, divided by change in sales multiplied by 100. Let us understand this PV ratio with the help of an example. S is equal to, suppose S is equal to 500 rupees. Variable cost is equal to rupees 250. Contribution is equal to S minus V. 500 minus 250, it will be rupees 250. PV ratio C upon S multiplied by 100. Contribution 250 divided by sales 500 multiplied by 100. It will be 50%. Now there is an important point to note down as far as PV ratio is concerned. If we are to earn higher profits, then we should increase PV ratio. It means for higher profits, higher PV ratio should be there. And for lesser profits, it means lesser will be the PV ratio. Every businessman will try to improve PV ratio. How we can increase this PV ratio? We can increase PV ratio by increasing contribution. This arrow which is pointed towards upward indicate increase. If contribution is increased, then PV ratio will also go up. If sales are increased, then PV ratio will also go up. If variable costs are reduced, then arrow is pointed downward. Downward indicate decline in variable cost. Any decline in variable cost will automatically leads to increase in PV ratio. Then we will study uses of PV ratio. Why we will calculate and study this PV ratio? There are certain advantages or uses of PV ratio. Number one, it helps to calculate break-even point. The most important step is break-even point, and in its calculation we require PV ratio. The break-even point is equal to F upon PV ratio. F here means fixed cost. It helps us to calculate fixed cost by expanding this formula. Break-even point is equal to F plus F upon PV ratio. If we expand it, break-even point multiply by PV ratio is equal to F. So F will be break-even point multiplied by PV ratio. Next uses is it help us to calculate sales. By rewriting this formula, F is equal to break-even point multiplied by PV ratio. By writing down the value of PV ratio which is equal to C upon S, F will be break-even point multiplied by C upon S. By further solving, F multiplied by S is equal to break-even point multiplied by C. S is equal to break-even point multiplied by C upon F. Next, third is break-even point, which is very important as far as marginal costing is concerned. It is a point at which there is no profit, no loss. It can be calculated by two ways. Number one, by drawing graphs. Number second, with the help of formula. Now we will discuss here the calculation of break-even point with the help of formula. Break-even point is a point where total cost is equal to total sales revenue. TSR here means total sales revenue. Break-even point in units, the formula is fixed cost upon contribution per unit. Fixed cost upon C mean contribution per unit. When we are to calculate break-even point in sales, then formula will be fixed cost upon contribution multiplied by sales. Calculation of break-even point with the help of PV ratio. Break-even point is equal to F upon PV ratio. Now the important question here arises, if selling price changes, then what will happen to break-even point? If selling price changes, contribution will also change. Then new break-even point will be calculated. New break-even point is equal to fixed cost upon new contribution. New contribution means new sales minus variable cost. Now if break-even point is shifted, when there is a shift in break-even point, then formula of break even point will be rewritten f upon new contribution, or new contribution is equal to f upon break even point. When we calculate new contribution, we will write down marginal cost equation S minus V is equal to C is equal to F plus P by taking the left hand side of marginal cost equation. C is equal to S minus V. C here mean new contribution. New contribution plus variable cost is equal to sale, or sales is equal to new contribution plus variable cost. New formula which emerges over here will be sales is equal to new contribution plus variable cost. Now let us understand it with the help of an example. Suppose fixed cost are 40,000, variable cost per unit rupees 2, selling price per unit rupees 3. We calculate first contribution S minus V. S 3 minus variable cost 2, contribution rupees 1. Break even point in units, F upon C. The formula is F upon C. F here is 40,000, C here just calculated rupees 1. Result will be 40,000 units. Now break even point in rupees. It will be better to if we follow another example. Suppose sale is equal to rupees 3 lakhs. Fixed cost suppose 75,000. Here direct material cost given is 1 lakh. Direct labor expenses are 60,000. Direct expenses are 40,000. We are first to calculate here variable cost. Here variable cost is direct material plus direct labor plus direct expenses. Then variable cost will be rupees 2 lakhs. Then next step is to calculate contribution. C is equal to S minus V. C is equal to sales 3 lakhs minus variable cost 2 lakhs. Just calculated variable cost 2 lakhs. Contribution will be rupees 1 lakh. So PV ratio, it means C upon S multiply 100. C here 1 lakh, sales 3 lakhs, multiply 100, it will be 33.33%. Then break even point. Break even point here we will rewrite the formula again. Fixed cost upon PV ratio. Fixed cost, it is given in question 75,000. PV ratio we just calculated 33.33%. It works out to be 2,25,000 rupees. Next, fourth important term is sales at a desired profit. At different level of sale, how much we will earn profit, that will be calculated with the help of following formula. Number 1, when total amount of desired profit is given in a question and we are to calculate sales in units, formula will be fixed cost plus desired profit upon contribution per unit. If we are to calculate sales in rupees, then formula will be fixed cost plus desired profit dp upon PV ratio. Very important. Fixed cost plus dp upon PV ratio. Let us again understand this fourth term with the help of an example. For example, sales, suppose sales are 1 lakh rupees, profit 10,000 rupees, variable cost on sales, it is given in percentage, that is 70%. We are to calculate PV ratio, fixed cost, sales to earn a profit of rupees 40,000. If we are to earn profit 40,000, how much the sales volume will be? Now solution of this question. Here variable cost is 70% of sales, therefore variable cost is 70 upon 100 multiplied by 1 lakh, it will be 70,000 rupees. When variable cost is calculated, we will again write down marginal cost equation S minus V is equal to C is equal to F plus P. By taking left hand side of marginal cost equation, C is equal to S minus V, contribution will be sales 1 lakh minus variable cost 30,000, it will be variable cost 70,000, contribution will be 30,000 rupees. Now PV ratio, it will be C upon S multiplied by 100. C here means contribution 30,000 divided by sales 1 lakh multiplied by 100, it will be 30%. Next step, we should calculate fixed cost. Fixed cost from marginal cost equation, S minus V is equal to C is equal to F plus P, by taking right hand side of marginal cost equation, C is equal to F plus P. C given, we have just calculated 30,000. F we do not know, plus profit, it is given 10,000. Then fixed cost will be 30,000 minus 10,000, it will be 20,000 rupees. Then third step is sales to earn a profit of 40,000. The formula is sales to earn a profit of 40,000 is equal to fixed cost plus DP, desired profit upon PV ratio. Fixed cost just calculated 20,000 plus desired profit given in question 40,000 divided by PV ratio, already we have calculated. Then it will be 60,000 upon 30,000. It works out to be rupees 2 lakhs. Next important term is margin of safety. Margin of safety is a difference between actual sales and sales at a break-even point. It means actual sales minus break-even sales. The margin of safety, if we want to calculate in units, will be equal to actual sales minus break-even point sales. Margin of safety, if we want to calculate in rupees, it will be profit upon PV ratio multiplied by 100. Now, what does margin of safety here means? Every businessman would like to have higher margin of safety, because higher margin of safety means secured business. It means progressive business. Every businessman would like to stay above break-even point. If he stay above break-even point, how much he is above break-even point, that will be known as margin of safety. Lower margin of safety is a cause of concern. Every businessman would like to have higher margin of safety. Now, how we can improve margin of safety? By increasing selling price, we can improve margin of safety. By reducing fixed and variable cost, we can improve margin of safety. By change of product mixture, that is by replacing more profitable product with less profitable product. More profitable product will be added, less profitable product will be dropped. Then margin of safety will improve. Next, we can improve margin of safety by increasing production capacity of the firm. The whole concept we can understand with the help of this question, with the help of this example. Here we are given sales, year, sales and profit. Year we are given year 1, sales are 1,20,000 in year 1, profit is 8,000 in year 1. In year 2, sales are 1,40,000, profit in year is 13,000. We are to calculate PV ratio. Second, break-even point. Third, profit when sales are 1,80,000. Sales are 1,80,000. Profit when sales are 1,80,000. Next, number 4, margin of safety for second year. Fifth, sales to earn a profit of rupees 12,000. If we are to earn profit of 12,000, what will be the sales? So now come to the solution aspect of this question. First of all, in every practical question, we are to write down marginal cost equation. Marginal cost equation is equal to S minus V is equal to C is equal to F plus P. Then we are to calculate PV ratio. At third step, we are to calculate fixed cost. Next, we are to calculate variable cost. Always first calculate contribution by writing down marginal cost equation. Then we will calculate PV ratio. Then afterwards fixed cost. Then afterwards variable cost. Now PV ratio over here, as data of 2 year is given, we will consider change in profit. Profit is given, there will be change in profit divided by change in sales multiplied by 100. Change in profit 13,000 minus 8,000 divided by 1,40,000 minus 1,20,000 multiplied by 100. It will be 5,000 upon 20,000 multiplied by 100. PV ratio will be 25%. In the second step, we are to calculate break-even point. We will write down the formula break-even point, fixed cost upon PV ratio. Here, fixed cost is not given. Then we are first to calculate fixed cost. We require fixed cost in order to calculate break-even point. As we have just calculated PV ratio is equal to C upon S multiplied by 100. It is 25%. It means contribution is 25 rupees. Sales are 100 rupees. Now, we will calculate contribution in second year. In the second year, sales are 1,40,000. 1,40,000 multiplied by 25%. It will be 35,000. Contribution in year second will be 35,000. By putting this figure in marginal cost equations, left hand side, C is equal to S minus V. C or just calculated 35,000. Sales in year second given 1,40,000 minus V. V will be 1,40,000 minus 35,000. It will be variable cost will be 1,05,000. Now, by writing down the right hand side of marginal cost equation, C is equal to F plus P. C is equal to F plus P. C 35,000, F we do not know. Profit in year second given 30,000, 13,000. The fixed cost will be rupees 22,000. Now break even point is equal to fixed cost upon PV ratio. Fixed cost just calculated 22,000 divided by PV ratio already calculated 25%. It will be 88,000 rupees. Next, third step is profit when sales are 1,80,000. How much profit we will earn if we sell goods worth rupees 1,80,000. As we know, contribution is 25% of sales because PV ratio is 25%. Therefore, contribution at sales of 1,80,000 will be multiplied by 25 upon 100, 45,000. By writing down the right hand side of marginal cost equation, C is equal to F plus P. C just calculated 45,000. Fixed cost already calculated 22,000. Profit will be rupees 23,000. Next, fourth, margin of safety in year second. Margin of safety, the formula margin of safety is profit upon PV ratio profit upon PV ratio multiplied by 100. Now profit in year second, it is 13,000. 13,000 divided by PV ratio, which is given in percentage. Then the result will be written as 13,000 multiplied 100 upon 25. It will be 52,000 rupees. In order to earn profit of 52,000, we are to sell goods worth rupees 1,80,000, or at 1,80,000 sales we will earn profit of 52,000 rupees. Next step is sales to earn profit of 12,000. If we are to earn 12,000 rupees, how much goods we are to sell? How much will be the sales volume? S is equal to F plus DP upon PV ratio. DP here is desired profit. Fixed cost already calculated 22,000 plus desired profit just given 12,000 divided by PV ratio already calculated. Then it will be 34,000 multiply 100 upon 25, it will be 1,36,000. We are to sell goods worth rupees 1,36,000 in order to earn a profit of 12,000. Now we close down our discussion here. The next aspect of this chapter will be discussed in next lecture, which will be uploaded very shortly. If you have any kind of queries or questions in mind, you can also contact me on my above mentioned telephone number, that is 94171365996.